Hi there, welcome to Kneppy Invest. August is almost over. In fact, I'm recording this at 4:14 p.m. on the 31st of August. And right now, I can tell you the majority of financial reports for the financial year or half year have been released by now. There will be some stragglers, particularly very small cap companies, that will release their reports during the next few hours and before trading begins on the 1st of September, because there is a requirement by the ASX that they have to release it by the start of trading on the 1st. And if they don't, the shares automatically become suspended. Now, typically, not always, but typically, most of the big cap companies or the major companies on the ASX will release their reports before the last few days. Now, there are a few big companies that did release their reports either yesterday or today, including Flight Centre and Harvey Norman. But by far, the majority of companies releasing their reports in the last 2 days are small cap companies. And it's not the fault of small cap companies. And this is something I have heard. It's because of the auditors. Auditors maybe not prefer to do the bigger companies, but they do the bigger companies first, financial statements first, and then they leave the small companies to last. So not really the fault of small cap companies that they get to release their half year or full year reports in the last few trading days. Now, in today's video, and this will be the last August 2023 reporting video, and even though most of the big cap companies have already released their reports, there were still a few interesting reports that I'll talk about in today's video, and also look at some other interesting announcements. So not only will today's video be concentrating, not completely concentrating on half year and full year results, also have a look at some interesting movements in share price because of other interesting announcements. Now, Harvey Norman was probably the only big company. I was probably wrong. I think there was a few other. Maybe IGO also released their report today. Atlas Eteria as well. So, and Sandfire. So it's wrong for me to say Harvey Norman was the only big company to release their report, but I'm going to focus on Harvey Norman right now because their share price is up 5.2% upon the release of their report. Now, I did have a very quick glance at Harvey Norman's report, and everything was down. So EBITDA down about 300 million, profit before tax down about almost 300, 400 million, profit down a fair bit as well. Operating cash flow up a little bit. So just based off the numbers, they didn't have any percentage movements here, which is understandable because it's down. Here we go. Here's some percentages. Profit before tax down 28% on financial year 22 and up 35% on financial year 19. So I wasn't really sure, because I don't really follow Harvey Norman all that closely, whether the market would respond favorably to these numbers or unfavorably, because it's not the numbers the market's reacting to, it's whether the numbers beat expectations and whether there's any positive or negative outlook from the company. So based off the market reaction, share price up 5.2%. Obviously, the report is a little bit better than what the market expected, or maybe Jerry Harvey decided to put some positive spin in the outlook. Who knows? Now, one of the reasons I wanted to show you Harvey Norman is just a chart. So the share price of Harvey Norman has been a downtrend, and this is a possible breakout for Harvey Norman. I decided to put Harvey Norman onto my watch list just because of what's happened today. Now, the last time share price was this high was not that long ago. We're talking about 6 months ago. So it's not the typical 1 year high I am looking for, but possibly this downtrend share price is coming to an end. Now, we saw a similar sign back in January of this year, and that was a false potential breakout. But on that occasion, there was no single day, no large volume coming through, which we could say, yeah, this is looking favorable for Harvey Norman, unlike today. Now, the only problem today is we didn't see really high volume. I would have preferred really high volume, but a pretty good day for Harvey Norman, a really good one-day candlestick for the company. Now, to some other companies, and I've got a lot to go through here. So that's about, I can tell you exactly how many I've got to get through. 24. So 23 more to get through in today's video. Now, the next one is City Chic. This is one I was paying attention to. It was City Chic, Baby Bunting, a few other retail companies. I wanted to see how they reported and how the market reacted. And the main reason is because the share prices of these companies have been in a significant downtrend for a long time. In fact, City Chic has been in downtrend since the start of 2022. So we're talking about 18 months. And back then, the share price of this company was about $5. Now the share price of City Chic is 45.5 cents. So the share price of this company has dropped 90%. And the share price has been in a well-defined downtrend. This is the classic downtrend. You won't see better downtrends than this. I'm not sure if I could use the term better, but this is a company where you should not have been buying into no matter what because of this particular chart. However, in saying that, share price looks like it is going sideways, consolidating since about December last year. So we're talking about a 9-month period. The share price is going sideways. We did see a little bit of a rally in the share price over the past, we'll say, month and a little bit. Share price has pulled back a little bit. And I have been trading this, but I have subtly changed my rules into trading. And based off my new rules, I would not have traded City Chic just because the share price is still in a downer trend, and I would classify this company as a low quality company. High quality companies typically don't drop their share price by 90% in 18 months unless we're going through a significant depression or something like that. And because of that rally, you can see that rally moved into this red zone, which is a long-term trend. And what I want to see is that shorter-term trend, which has turned green. In fact, it might be the first time it turned went slightly green back in August 2022, but you can see this trend was still down at that point. So what I want to see here is the short-term trend get above the longer-term trend. And when that does happen, you slowly see the long-term trend starting to climb higher. And the other very important line I've got here is 150-day moving average. And I want to see the share price get consistently above that. And I want to see signs that the trend in the share price is shifting and the sentiment is also shifting from negative. Actually, we could say it's neutral right now with this company. So neutral to negative to positive. And I was thinking potentially their results could have shifted sentiment, but didn't. Share price down 8.1% today after being down about, I think it was about 4% yesterday. You can have a look at that. 4.8% yesterday. So I actually had a dream about this because I did an investor shift overnight, and typically before night shifts, I will take a nap. And then I had a dream about City Chic. The share price was up 200%, but it was down 4.8%. I don't know why I was dreaming about City Chic because I'm not a shareholder of this company. And if you do have a look at the numbers, everything was pretty bad, but expectations were City Chic numbers were going to be pretty bad. So revenue down 15.8%, underlying EBITDA loss of 24 million, inventory reduced to 53.8 million. So that's a little bit of a positive, and net cash position of 10.9 million. So I really want to see some sort of positive signs that City Chic is turning things around. And the market cap of this company is 124 million, which is fairly low. So if it's 124 million now and the share price has decreased 90%, that means the share price at its top would have been about 1 billion, over $1 billion. Jeez, things have really fallen bad for City Chic. But this is the sort of thing I am looking for on the ASX, is these potential turnaround stories. Now, there is that saying that turnarounds seldom turn around. That's completely false, even though Warren Buffett said it. And I'm thinking he's more referring to companies that have been around for a very long time, very mature companies. And when they start to die off, and through history, we have seen companies die off once they become mature, and then they slowly wither and die. Those sort of turnarounds don't turn around. I wouldn't call this that classic turnaround story that Warren Buffett would be talking about. I could be completely wrong, but turnarounds, there's a lot of companies do turn things around, particularly if there's short-term issues. And that's the other thing. I think City Chic has faced some short-term issues, and they're trying to deal with that right now. Now to another company. They did not release, I don't think this company released any financial results, but yesterday the share price dropped 25.2% and then has dropped another 8% today. And this company is Chalice Mining. Now, the reason I'm not interested, I've never held this company before, but this was a cult stock on the ASX back in late 2020 into 2021. The share price of this company from round about the COVID-19 financial panic period, share price of this company rose from about 15 cents to a high of $10.50 in about 18 months. Just look at that chart. So if we go back, all the way back to when the share price of this company broke out, we can start to see starting to see share price increase in the middle of 2019. And then on the 23rd of March 2020, which was the bottom of the market, share price of this company rose 137.5% on massive volume. This is a classic breakout. Beautiful. This is, if I was paying attention, I would have seen this as a potential buy on this particular day. More than likely, I was not paying attention at all to this company. So 137.5% in one day. Next day, the share price actually dropped 15.8%, but then kept on rising. And if you actually bought on that day, see, even at the top, on that day, that 137.5% rise day, you'd have bought at 39 cents. And 1 month later, the share price was about $1.30. So even though the share price rose 137.5%, the share price still tripled from there over the next month and then kept on rising. So what's happened to Chalice? There was a beautiful uptrend, and then the uptrend turned to a downtrend in April 2022. Well, then there became a lot of volatility here. I wouldn't call this a downtrend or uptrend at this point in time, and then moved into a definitely downtrend before whatever happened on the 30th of August. So let's have a look at what happened. I haven't had a look at this. I don't know why Chalice Mining has gone down a lot. So 5.3% today. And this has to do with, so before or after trading had finished on the 29th, which is the Tuesday, they released a scoping study for the John Gonaville Nickel Copper PGE project scoping study. And obviously, the market didn't like that scoping study. Now, I'm not an expert in scoping studies, so maybe that's one of the reasons I did not even open up that announcement. But obviously, those who know about scoping studies saw it, looked at it, and went, oh, this is horrible. And the share price has taken a massive hit for Chalice Mining on massive volume. Now, when you look at the share price is right at those lows we saw back in June last year. So this could be potential buy for those who believe this is a nice little support zone because it's reached the past lows over 1 year ago. It's up to you. I don't care. Onto a company. Now, this company is called Advanced Zinctek. They have this zinc-like sun cream lotion, whatever you want to call it. I don't know. And this company did release the results on the 30th of August. Share price decreased 26% on the day and has dropped another 25.9% today. So share price has dropped by over 50% in 2 days. Share price has dropped around about 50%, we'll say. It actually would be under 50% because, it's definitely under 50% just because of mathematics. Anyway, I know this company because I once held this company way back. Look at that chart. Look at this. This was, I wouldn't call it a hype stock. You can see the chart for this company back in 2019. Look at that rise in share price. Jeez. I held this company before that massive rise in share price. And then I sold for a small profit. So I had this company at about, it was about 20 cents. It was actually about 2 cents because the company did a share consolidation. So like probably a 10-to-1. And so I bought the shares at 2 cents, sold like at 3 cents and thought I was a genius. And the share price kept on rising. So based off this chart, I sold at 20 cents, bought at 20 cents, sold at 30 cents. And the share price went all the way up to a high of $7.75. So I always remember this company. Anyway, now this company is profitable. It was profitable. And maybe the reason why the share price has dived in the last two. Funny enough, the biggest volume has come today, the day after the release of the results. So it's very small volume compared to today. Yesterday, still the share price dived. I think this is just panic selling potentially. This could be capitulation as well. A lot of volume in May as well. So about over about a 6 to 8 trading period, high volume, not a lot of change in share price. So let's have a quick gander at Advanced. They used to be called, I forget what they used. They changed the name. I forget what they used to be called. They weren't always called Advanced Zinctek. So, well, unfortunately, they don't have any media release. So let's open up the Appendix 4E. So revenue up 9.9% to 13.7 million. Profit down 37.7% to 2.3 million. And then down 24%, that's after tax, to 1.7 million. So this company's still profitable. Looks like they're also paying a dividend. No, that's final dividend paid 22nd of March, 2023. So obviously, people didn't like this at all, and the share price has dived. Market cap of this company is now down. After today, would be down to, it was 93 million before today's drop. Divide that by 4. We're talking about 70 million or so market cap of the company. Yeah, interesting share price action and volume with Advanced Zinctek. Now on to Dusk. This is another company I have held in the past, but I will always say this is always probably point to Dusk Group as a success story. So one of my success stories. So this company listed towards the end of 2020. And I do have a rule not to buy in IPOs until at least they've been on the ASX for 6 months. This was an exception because I took a position in this company on the 29th of December 2020. So they listed the 2nd of November. The main reason I took a position on the 29th of December was because of a profit upgrade. And before that, the share price was moving up as well. The share price on this particular day rose 12.8%. And I bought shares at right on, was it $2? Yeah, right on $2. And then I sold shares not quite at the high at $4, but just shy of $4. And that was just before the share price moved into a downtrend. So just remember, this company listed about $1.60. I bought shares at $2. Share price of this company is now $1.01. And share price has been a well-defined downtrend since the start of 2022, and no end in sight. We just like any company in a downtrend, we do see rallies, short-term rallies in the share price. And for this company, the short-term rallies fall away or fail, what do you want to call it, when the share price moves into the long-term uptrend. And the last rally we did see actually didn't even get that far because a significant decrease in share price before that. Share price actually went down from $1.50 all the way down to about 80 cents in about a 1 month. Anyway, share price down 3.3% today, down 9.5% yesterday. So obviously their results were not good. Market didn't like them, disappointed the market. So let's have a quick gander at Dusk Group's report. I'd say negative numbers. More than likely, these are going to be negative numbers because they probably would have guided towards negative numbers. So let's have a look. Sales down 0.6%, but positive up 36.5% on financial year 20. Like-for-like sales, this is very important. I always like to look at like-for-like sales, down 13.2%. This is very important because overall sales only down 0.6%. So obviously they opened up new stores. And the stores they already had online or opened up, the sales for those stores down significantly. Gross margins down 3%. That's also very important. You want to see gross margins maintained. No, yeah, it says down 3%, but gross margin rate down 1.6%. Pro forma EBIT of 16.5, net cash of 16 million. Don't talk about profit at all here. And final dividend of 3 cents, bringing full year dividends to 11 cents. So interim dividend 8 cents. I can obviously see why the share price is in a downtrend. Business has really slowed down for Dusk Group. However, the market cap for this company is 72 million. I'm now interested in this company. But even though I'm interested in this company, I'm not going to buy any shares, even though I think there could be value here. The main reason I won't buy shares is because the share price is in a downtrend. Now, onto a company which we didn't see much of a market reaction from their results. This is a company I own, so I'm being a little bit biased here. So this is in my medium-term portfolio. So I will own this company for as long as possible. This company is called Rectifier. They do stuff with EVs and that sort of thing. This is exactly the sort of company I want to own, or maybe I could even say you want to own. You don't want to own the lithium companies, the car companies. You want to own companies sort of like, in gold rushes. You don't want to be the person rushing for gold. You want to be selling the picks and shovels to those who are rushing for gold, because those are the ones who make money. Or maybe if you made jeans. Anyway, I'm pretty sure Levi Strauss, whatever it is called, they started selling jeans during the gold rush period. Anyway, so the reason I want to show you this, and I was a little bit surprised the lack of interest in the market, and I think the lack of interest is because the market expected it. So revenue up 144.2% to 39.8 million. Profit before income tax, 8.7 million. After income tax, 6.5 million. So again, profit 6.5 million. Now, I would say there will be some people complaining there's no dividends. This company should not be issuing any dividends to their shareholders. Absolutely not. This company should be all about growth. And I've said this before, research has shown that dividends suppress innovation and growth. It's one of the reasons why Berkshire Hathaway have never provided a dividend to their shareholders, because it's not good capital allocation for those companies that believe they can do a better job than the shareholders in deciding what to do with the money that's coming into the company. Anyway, so that's just my opinion. I don't ever look at dividends when I'm looking at a company at all. I would prefer most companies not to have a dividend, because I hope most companies I own are aiming for really good growth in the future. I don't care about any token dividends. Like 1% dividend's okay, but if I see a company with a 5-8% dividend, now I'm being general here because I have owned companies with an 8% dividend, but the main reason behind that is just for the nice income. And if the company can maintain a share price with an 8% income or 8% dividend, that's actually a nice, pretty gain. Anyway, so the market cap of this company, remember, profit over $6 million. The market cap of this company is 73 million. So we're talking about a PE ratio of fairly small. And when you look at the growth, 144% growth in revenue, 1,000 growth in profit, more than likely margins have increased. Now, I haven't had a complete look at this report yet, but maybe this is just a one-off, and maybe the market is concerned that all these numbers will significantly drop off in financial year 24. That's potential. But when you do actually look at the long-term chart for this company, it's slowly creeping up. Slowly. You better see that if you look at the weekly chart. It's just slowly grinding up. Not grinder, but grinding up. Look at that. This goes all the way back to 2014-15. The share price of this company at one point was 0.1 cent. Not 1 cent, 0.1 cent. So the share price of this company has gone from 0.1 cent to 5.4 cents. So like a 5-bagger. For those 5-bagger, no, that's not a 5-bagger. That's a 50-bagger. For those who have held strong. And you can see there is a bit of volatility with this company. So at times they release announcements and the market gets way overexcited and then share price pulls back. And I bought on one of those pullbacks. I think I bought somewhere here on this last pullback. 29 Metals, share price up 17%. Why is 29 Metals share price up 29%? This company I've been looking at because this is a copper miner. They had some problems with one of their mines because of flooding. I think it was called Capricorn near Mount Isa. Share price rallied 17.3% today. Let's have a look why. I haven't been following this company at all. And the company, let's have a look, released their results yesterday. And share price did nothing yesterday. And what happened today? Oh, and not only did they release their results, half-year results, they also announced a capital raising. And the only thing that happened today was completion of institutional component of entitlement offer. So what I'm thinking is happening here is the market was expecting a capital raising. I probably was expecting a capital raising as well for this company. And because this capital raising is over and everything's fine now, this mine will get back up to production, that sort of thing. I think the risk around this company has decreased significantly. And that's why the share price has rallied today, because decreased risk. Now, most investors hate risk. Probably the best way to say that is the market, the equity market hates risk. And so when this sort of thing happens, when a company does a capital raising, a lot of times capital raising can be negative, but in this case, a capital raising is positive because it was expected, and now this capital raising has de-risked this company. I wouldn't buy this company just yet because share price is still in a downtrend, even though share price has risen 17.3% today. This is just based off my new rules that I have developed. Now onto a company called Atlas Pearl. Who's heard of this company? So if you love pearls, potentially this is the company for you, because share price up 20.4% today. And I had a very quick look at their results. They did release their results today. This is a small company. So market cap of less than 20 million yesterday. So today the market cap would be, say 18.36, about 22 million or so. So let's have a look at why the share price is up 20.5% today. So they released their results. Now, no presentation, no media release, because this is a small company and the majority of fund managers have never heard of this company. Atlas Pearls, I have looked at this company briefly in the past. It is interesting, but revenue up 26% to 27.2 million. Profit up 98% to 9.1 million. There was a special dividend of 0.35. There is a dividend. This company has a dividend. Net tangible assets per owner share, 8 cents. What's the share price? 5. Net tangible assets, 8 cents. The share price is 5.3 cents. Okay, we can sort of understand why the market might be getting a little bit interested. I'm going to do a little bit more research on this company, just based off what I see. So, Harvey Norman and Atlas Pearl. That looks ridiculous. 9 million profits for a company with a market cap 22 million. Obviously, there's probably some accounting stuff happening here, funny accounting stuff happening to raise that profit to 9.1 million. And now, if they had revenue of 27 million and profit of 9.1 million, the margin in this company would be absolutely brilliant, and the market cap would not be 21 million. Now, I'm not going to have a look at, actually, let's have a look at the annual report. Let's find out why the profit's 9.1 million. And we're going to leave that for the next, because it's going to be, for some reason, yeah, it's going to be a while before it opens up. Now onto Betmakers. So people have been getting excited about this company and PointsBet. I don't know why, because look at the chart. Share price in a well-defined downtrend. They released their report yesterday. Share price down 15.4%. Share price down another 4.6% today. So again, this is just using my own rules, staying well clear of this one, because the share price in a well-defined downtrend. Share price has been consistently below the long-term trend. And in fact, as soon as the share price gets to the long-term trend, we see sell-off. We saw it back here. So we've seen it 1, 2, 3, 4 times. So no reason to get excited about Betmakers. I'm not going to have a look at their report. So Atlas Pearls. So what they do? Well, we know what they do because it's in the name. Producing the world's finest South Sea pearls sustainably and respectively, while caring for our environment, people, communities, and shareholders. You know, I don't care about that. I only care about money. Nice little photo there of pearls. Ooh, nice pearls. Anyway, let's have a look. I just wish the financial report was right at the start. Here we go. So revenue, gross profit, $6. The gross margin of this company are pretty good based off these numbers. Administration expenses, $6 million. Doesn't look like there's anything weird happening there. That looks legit, 9 million. Market cap, 22 million. Total equity, 34.1 million, significantly higher than last year. And cash flow, $8.4 million of cash flow. $5 million of cash flow last year. Cash flow has increased from 5 million to 7.8 million. They've repaid some borrowings. That's good. Capital expenditure 2.1. So free cash flow 6.3 million. Free cash flow last year was 3.3 million. Jeez. You can see why the share price is up 20%. Oh, I'm going to do a little bit more research on Atlas Pearls. It looks interesting. Now, I'm not sure about the business model. I'm not sure about pearls. Is this the only pearl company on the ASX? Probably. But anyway, interesting. Anyway, so Atlas Pearl, Betmakers, share price in a well-defined downtrend. Not even sure why I included Betmakers in today's video. Peninsula. Now, their share price decreased 24% today. I don't know why. So let's figure out why. Peninsula Energy, this is uranium. And this has been a disappointing uranium company recently. Share price down 24.7% or 25.2%. So no results. But today at 8:47 a.m., lands production to restart in 2024 under revised LOM plan. So I'm pretty sure LOM means life of mine plan. I'm not even going to open that up because we know it's negative by the market reaction. Huge volume also coming in today. So yeah, this is really negative, down 24.2%. And again, this is not a company I would have been holding. I have held this company in the past, but when the share price has been in an uptrend, back here, 2021, this was an uptrend. Pretty volatile uptrend though. And share price has been in downtrend for a while now. Looked like it was trying to break out in June, and then the company released some negative news in July. 19th of July. What was the 19th of July? Let's go have a look. Peninsula delays production, accelerates in-house resin processing. Okay. So I'm staying clear of Peninsula. So if you love uranium, why not buy Boss Energy? You just see the difference in the charts here between Peninsula and Boss Energy. Look at that. This is a beautiful chart for Boss Energy. Maybe even everyone seems to love Paladin. Want to see if this is in a beautiful uptrend too? No. So by far, out of these three companies, Boss Energy is by far the best. Now, that's only those three companies. Maybe there's another, a better uranium company. Shut. Now, it's a company whose share price increased 78%. You can't even see it. This is unusual. Share price in a downtrend. Well-defined downtrend. No reason to be holding this company unless you thought that this company, which is called Healthia, I believe, Healthia. I don't know what this company does. Okay, it's a takeover bid. HLA Healthia enters into scheme implementation deed with PEP. So significant premium to the share price. That's why it's up 79%. And let's have a look. I also released their preliminary final report, which might be pointless now. So let's have a look at how this company is doing. The market cap of this company, 136 million. They do have a dividend yield, so this company should be profitable if they've got a dividend. God, I don't know why this is so slow. It's pretty ridiculous because I do have fiber to the premises, and typically it's fast. Revenue, 252 million, but profit's only 6 million. The margin on this company is pathetic. Underlying net profit after tax and A. What's A? Net profit after tax and amortization, I am assuming. Yep, plus amortization. I would not look at that at all. And they do have a dividend. So another company going bye-bye on the ASX, more than likely. But some shareholders probably wouldn't be happy because they bought back in early 2022 at $2.40 and share price $1.75. So it's Healthia. Now to Next Science. This is a company, another company I've held for a very brief period of time. This was just a trade back here, this little period where the share price started zooming higher in May 2021, and then I sold pretty quickly. And share price has been in downtrend. And just like many other companies, that long-term moving average, we'll say envelope, whatever you want to call it, is the resistance zone for this company. When the share price gets into that zone, share price pulls back. So we want to see that sort of resistance zone being broken. Now, there is possible signs that things have bottomed or are bottoming out for Next Science, but for some reason today, the share price has dropped 20%. So why has the share price dropped 20%? It's really exciting because I have no idea why some of the share price has moved around. I didn't have a look at the announcements this morning at all. It says no announcements. That's BS. Okay, there we go. Next Science have released, half-year results and capital raise update. Now, this company is not profitable. They are burning through cash. Positive EBITDA and cash flow expected during the second half of financial year 24. So maybe it was just these capital raising they didn't like. I don't know. Where's this capital raising? Okay, they are pleased to announce they have successfully completed a placement, raising $12 million at a price of 42 cents. I don't like these sort of things when only institutions get capital raising and shareholders don't have a chance to participate. Oh no, there is a share purchase plan. Excuse me, there is a share purchase plan at 42 cents. So share price 52 cents. That's why the share price has decreased, because this capital raising is being done at a significant discount. So 35.4% discount. And I don't understand why companies do that at a significant discount, because the share price is going to absolutely plummet. So there's no attractiveness to it for anyone, in my opinion. Just do it at a small discount, because, it's just dumb. Anyway, nothing else to say about Nexus. Not even sure I should talk about this company, DRA. Share price in the massive downtrend. Share price has fallen from $4.50 to $1.50. I did actually do a video, introduction IPO video to this company, DRA Global. Now the share price up 12.7%. They would have released their half-year results today. Yeah, they did. These must have been pretty good. So let's have a look to see the results of DRA. So underlying EBIT 23.5 million, significantly improved compared to last year, which was a loss of 16.4 million. Revenue 424.4 million, but that is down 11%. And more than likely, I would stop right there. So even though all the other numbers are positive, revenue is down, which is not a good sign for me. I want to see revenue rising. Now, just because revenue has dropped from one year to the next doesn't mean revenue will continue to drop, but it's not a good look when revenue has dropped in this year. Net cash is up. So I can see some positive things in this company, but the margins of this company would be pretty low. So, and the chart looks pretty ugly. And not only does it look ugly, these shares in this company are illiquidly traded. You just look at the buy and sell list here. The depth probably is the best way to put it. Depth's pretty pathetic. The first buyer is $1.53. First seller is $1.70. So it's going to be difficult to match it up. Would even say that shares in this company are sometimes not traded. And when we look at the trade history, there's at times long gaps between days when shares are traded. So 28th of July, and then the next time shares were traded was the 10th of August. So I'm not even sure why I included DRA Global. Maybe just because the share price up 12.7%. Just like JYC, Joyce Corporation, share price up 18%. Now, when you look at the chart for this company, I'm pretty sure this is retail. I'm pretty sure this company, I could be completely mistaken, this company also has an auction, Lloyd's auction, something like that. But look at that chart. It's all over the place. It's just so volatile, and this is not a breakout at all. So this is not what I'm looking for. And one of the reasons why it's actually a negative one-day candlestick, and we're not at least a 6-month high. Last time share price was this high was, actually, this is a 6-month high. March, not quite. So let's have a look, quick look at Joyce. Let's have a look at these numbers to see if there's anything positive that we can take away from Joyce. Revenue, 144.7 million, increased 12%. Profit, 17.7 million. EBITDA, 32.6 million. Net profit attributable to Joyce shareholders, 9.1 million. Earnings per share, 32 cents. So let's have a look, 32 cents. So P/E ratio less than 10. Fully franked dividend, net group cash. Not even sure what sort of retail they do. Household discretionary spending. Their core businesses, KWB and Bedshed. So it looks like they supply kitchens, wardrobes, bedroom mattresses, and furniture, which you'd think would be struggling right now. That sort of, although Nick Scully had a pretty good result. What else do they have? I thought they had some sort of, they had some sort of auction thingy. Maybe it's a completely different company. I am thinking of. It's very hard to know what all 2,000 companies do on the ASX. No, I'm not. It must be some other company I'm thinking of. Anyway, so some good performance from. I've never heard of KWB Group, Wallspan and Kitchen Connection. When you look at some of these graphs, they actually looks pretty good. Bedshed, never heard of Bedshed either. Anyway, maybe another company to put on my watch list. Nice reaction from the market, but not the best one-day candlestick, however. Share price actually closed at the low of the day. So share price opened at 315, went to a high of 342, and the low was 310 and closed at 310. That's actually quite negative. Even though share price did rise 18.3%, the very fact the share price closed at the low of the day is actually negative. The main reason share price closed at the low of the day is because there were extra supply of shares on the market because a lot of shareholders bought at higher prices in the past year and a half, 2 years. So that adds pressure to the company's share price. Now on to medical developments. This has the green whistle. This chart price of this company has been a downtrend, massive rally in the share price. Share price went from 75 cents to $1.75 in about a month, or maybe less than a month, but that was not a breakout. The reason it's not a breakout is because if you look at the shorter term moving average, it just can't get through the longer term. So this short-term movement in the share price was just short-term traders. The long-term traders didn't care about this, or the long-term investors. That's the way I look at the longer-term moving average envelope is the long-term investors. The shorter term is the shorter-term traders who can be quite fickle. They can get excited about a company and then lose interest in the company fairly quickly, just like Medical Developments International right here. And the share price has dropped from $1.75 all the way back down to 88 cents. Now, this company did release their results. This company is one of the companies on my watch list. I will be following this company because if they can really take advantage of that green whistle, particularly into America, I still think they're trying to get FDA approval, if I remember correctly. And if they get that, this is a company to have in a watch list. This used to be profitable, not anymore. Revenue increased 10.4%. That doesn't look like 10.4%. Oh, 10.4 million. I was going to say that's not 10.4. Company not profitable anymore, burning through a fair bit of cash. USA market entry advancing. Market assessment identifies $300-400 million commercial opportunity for Penthrox, which is a green whistle advisor appointed to support partner search. So again, if they can get approval to sell this green whistle in the United States, I might become interested, and I think the market might become interested in Medical Developments International. Chart looks pretty ugly right now. On to another company I was paying or wanted to see the results, and that is Swoop Holdings. This is another company, share price in a well-defined downtrend. Share price bounced and see a nice little rally in the share price on fairly low volume. Share price has pulled back, but this was a case if they release some really good results and the share price boomed to say 35 cents to 40 cents. This could be that breakout, very close to that breakout. And that's one of the reasons why I was waiting patiently. I was going to say waiting patiently for these results. And I'm being a bit facetious when I say patiently waiting because I wasn't patiently waiting. So they did release their results today. And so I did have to put the TIG code first. And you can see the share price down 9.8%. So obviously disappointed the market. Now, I'm going to show you, because I actually did have a look at their financial statements. So revenue up 30 or 51%. This is what I want to see. This is one of the reasons I am interested in this company because they're going to have pretty good growth in revenue, $78 million in revenue, but loss of $37.5 million. Now, that does not mean anything because there could be a one-off. And I have seen a lot of investors just pay attention to the loss or profit and just focus on that. And this happened to, who was it? Was it Bravura? Some people just focused on the profit and they couldn't understand why the share price was up 44% when this company lost 200 million or something like that. You don't focus on the loss because a lot of times there's going to be one-offs. But the one thing I wanted to focus with Swoop is, where's the financial statements? So I don't really care about the profit and loss. And actually, before I go to the cash flow statement, so what I'm talking about one-offs here, impairment charges, 27 million, which actually is less than the loss. So there were some other reasons why. Share-based payments, 1.2 million. Depreciation and amortization expense, 18.6 million. And this is very important. So fairly high depreciation amortization expense. If you take that out, take out the impairment charges, this company would be stating they were EBITDA positive. So let's have a look at this announcement. And I would say they are highlighting they are EBITDA positive, probably underlying EBITDA positive. So let's have a look. First point, revenue up 51%, gross margin up 14%, underlying EBITDA 16.3 million, up 25%. So it's fair, and they also mentioned operating cash flow, which is very important here as well. So underlying EBITDA, operating cash flow. Now, underlying EBITDA doesn't include amortization. Operating cash flow doesn't include any research and development or capital expenditure that they capitalize or whatever, particularly if it's research and development. So it's very important when you look at this company to look at the depreciation, amortization, and also in the cash flow statement, look at investing cash flow. So let's have a look at investing cash flow, and this is very important. So even though this company was operating cash flow positive by 13.8 million, that looks really good. 8.9 million last year. So that looks really good if you just focus on that. So you've got to pay attention to cash flows from investing activities. Don't pay attention to purchase of subsidiaries and that sort of thing. Payments for property, plant, and equipment, 16.7 million. So this company is spending a lot of money on capital expenditure. I would say a fair bit of that is for growth, though. And that's why they capitalize it, and that's why it's in amortization. I'm not sure if I'm actually doing that exact. There could be an accountant actually throwing stuff at the screen right then, because I'm not sure capital expenditure is amortized. Definitely research and development, you can capitalize that or expense it. But payments for property, plant, and equipment, take that away from the operating cash flow, then you get free cash flow. And this company was free cash flow negative by $3 million. They are still burning through cash. And in fact, proceeds from borrowings, 18.3 million. So let's have a look at the balance sheet. Borrowings, non-current borrowings, 16.9 million, and 1.8 million in the current liabilities. So they are now in debt, and I don't like that at all. So Swoop, a little bit more negative on Swoop right now, and looks like the market is as well. Now on to Bigtincan. Yeah, this company, massive, again, half-year results or full-year results, whatever. Down 8.2%. You know this is going to be negative. So this company always promises a lot of acquisitions, massive amount of acquisitions, and straight away, Bigtincan reports record adjusted EBITDA of 8.3 million EBITDA positive results for second half. I don't care about EBITDA. This is a sort of company that should not be reporting EBITDA, adjusted EBITDA, that sort of thing. Transition of business to cash flow break even with second half financial year 23 EBITDA positive is 0.1 million. The reason they should not be focusing on EBITDA is because, again, this company capitalizes research and development. You'll be able to see that when we look at their Appendix 4E. They spend a lot of money on research and development, so they also have a pretty high depreciation amortization. So hopefully you can be able to see that in this. In fact, they don't even include their depreciation amortization at all in a profit and loss. Hopefully they include it somewhere else. No, they just got adjusted EBITDA. Adjusted EBITDA. Okay, so let's go to the cash flow statement. So this company was actually operating cash flow negative. I expected that to be positive. So it's actually negative. And they also capitalized development costs 16.5 million. So that's going to be amortized over who knows how many years. And if you think that's just a one-off, it's not. Because last year it was almost the exact same cost, 16.6 million. Capitalized development costs, that's for research and development, for new software, that sort of thing. And they capitalize it over a certain amount of years. And then that's amortization over the next 5 or 10 years or whatever. So that's why EBITDA is not relevant for this company, because they have a pretty high amortization because of capitalized development costs. So I would never look at EBITDA for these type of companies. And the very fact they are focusing on EBITDA, I don't think is the best thing moving forward for this company. They need to be free cash flow positive when you include capitalized development cost. That's just my opinion. I'm pretty sure that's other people's opinion. Anyway, apart from all that, the share price of this company is in a downtrend, just like many other companies, in a downtrend. And this little support level, it's getting very close to that support level at 38 cents. We're 1 cent above that support level. Why is that a support level? Let's go all the way back. So last time the share price was that low, we're talking about the COVID-19 financial panic. Not sure why I put a support. Oh, no. The reason I put a support level there is it bounced off there back in March of this year. Anyway, Mayne Pharma. This is a company I've owned in the past, and I don't know why I own this, because this is a horrible company. Very low quality company that has just been awful over the past, who knows how many years, 5 years, 5 or 7 years. Let's have a look at the weekly chart. Yes, talking about 6 years. Look at that beautiful chart from 2013 to 2016. Share price went all the way up to $42. I don't think it was $42. I'm pretty sure this company has done a share consolidation. And then share price has been downtrend. Just look at this actually. So resistance zones can, remember I was talking about the long-term trend can be a resistance zone. Even if you look at a weekly chart, the long-term weekly chart here, the long-term moving average, weekly moving average is also a resistance zone for Mayne Pharma, because it's happened twice. Back in April 2021, share price got into that long-term moving average zone and pulled back. Same thing happened in August of last year. Anyway, what happened to Mayne Pharma? I don't follow this company at all because it's a horrible, horrible company. Down 22.7% on full year results. More than likely, this is going to be awful. Don't know why anyone would be even thinking about buying this company. So revenue up 17%. Reported gross profit up 17%. Reported EBITDA negative 102 million. Reported net loss after tax negative 317.4 million. Last year it was negative 220.1 million. Underlying EBITDA negative 95.3 million. Geez, so I'm not even going to bother looking at this company at all. They provided a 46.7 million special dividend to shareholders, initiated an on-market share buyback of up to 10%. They must have sold something. The only reason they would give a special dividend to shareholders is if they sold something. And more than likely, they'd made a really horrible acquisition back in 2016 for some drugs. This is a drug company. I think they sell those generic drugs, and those generic drugs they were selling, the prices of those drugs just came under significant pressure, and it was a horrible acquisition. Yeah, so not interested in Mayne Pharma. And again, if you look at the daily chart, weekly charts, share price in downtrend, daily chart, it started to look promising. So we're starting to see, we're starting to see a possible shift in sentiment and trend in the share price. But then what happened today? Share price down 22%. Poof. Not as bad as this company, which is CPT Global. Share price down 39% on high volume, and there's no reason to have been in this company. CPT Global, share price was in a downtrend. It's been in a downtrend since the start of 2022. Share price has decreased from 70 cents to 13 cents. Why would you have been in this company just based off this trend? And that's why my rules have changed. Don't be in these sort of companies where the trend is like this, because bad things are likely to happen. So let's have a look at this company. Why was the share price down a lot? CPT, I don't even know what they do. They released their results. And what's the market cap of this company? Let's have a look. $9 million. Well, after today, it's like $5 million. Jeez. Okay, let's have a look. Revenue down 6% to 28 million. Well, it has a little bit of revenue. That's pretty good. Oh, okay. So this company has gone from a profit-making company to a loss-making company. Not sure if it's worthy of a significant decrease in share price, although this company was also dividend paying. 1 cent final dividend in 2022, a 0.6 cent interim dividend, and a 0 cent dividend, final dividend right now. Ooh, that's one of the reasons why the market doesn't like this. The market doesn't like when a company, a dividend paying company, seizes their dividend, unless it's reasonable. Okay, so CPT Global, I've not looked at this company at all in the past. I'm not even sure what they do. I'd say it's a financial company. That's what I'm guessing right now. Is an information technology consulting company. Well, straight away, that's why I don't like this company, consulting company. It offers a range of information technology solutions such as technical consulting services and management of information technology. Yeah, not interested in what they do at all. MoneyMe. Talk about ugly charts. This is ugly chart. Come on. Why does Trading View does this? Just bear with me for a second as I fix Trading View. It shouldn't be doing this. Might have to just restart it. Reload. It takes so long. So let's go to MoneyMe. And this, if it happens, at ugly, just see by the, if we just zoom out, share price of this company has dropped from, we'll say about $2.30 in 2021, 2022, down to 7.7 cents. That is like a 98% decrease in share price. Why would anyone be holding this company right now? That's ugly, 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 ugly. But the share price is up 11.6% today. So let's have a look. Is there anything to get excited about MoneyMe? Well, that's the wrong company, first off. So I'm pretty sure this company is a loaning company, that sort of thing. 4-year results announcement. Market cap of this company, before we have a look, 55 million. So we'll say $60 million after today. Profit. So statutory profit pre-overlay. What the hell's overlay? ECL provision management overlay. Statutory profit 12 million. So P/E ratio of this company is 5. Cash profit 24 million. Is that cash operating cash flow? Gross revenue 239 million. Nice increase. Office operating cost to income ratio 22%. Gross customer receivables, average Equifax score. I don't know what that is. Okay, so this company is profitable. It's just what they do. I think the market is really concerned about what they do. Let's have a look at what the Managing Director and CEO says. I'm pleased to announce MoneyMe's strong financial year 23 performance, profit of $12 million, robust cash profit. Pretty sure that's operating cash flow. Could be completely wrong. In fact, we can look that up. And I don't know why I'm spending any time on this company, because just based off the chart, I would not even be thinking about buying this company just yet. So let's have a look at the next company as we wait for the annual report for that company to open up. Only 4 companies to go. Now to genetic signatures. I, at one point in time, was really interested in taking a position in this company when the share price was about $1.30. And I'm glad I didn't, because share price has been a downtrend, and the share price down 6.5% today. Market cap 66.7 million. This company, I'm pretty sure, does test kits things, testing thingies, detection kits things, whatever you want to call it, and diagnostics. That's it, diagnostics. And I would say, without even looking at any numbers here, I'd say revenue is down a lot for this company. They don't have any sort of media release, any presentation. It's just the Appendix 4E and annual report, and we know that's going to take a long time to open up. But if you want to have a look, genetic signatures, more than likely, revenue is down a lot because they do diagnostic stuff, and diagnostics has been awful over the past year, much less because of COVID-19. A lot of COVID-19 diagnostic testing, that's gone away. But you would think, because this company not only does COVID-19, they do other diagnostic testings as well. And I thought maybe the increase in those diagnostic testing could overcome COVID-19. So what I'll do is actually, we'll open up the annual report, and as we can, oh God, look, MoneyMe is still yet to open. Just, I don't know why it takes so long. Now to a company I actually do own, and this is a company I probably should not be owning because of the trend. And if I had the rules in place, I would have sold out probably when the share price of this company was around between about 50 and 60 cents. Share price now 33.5 cents. Now, in saying all that, they did release their results today. Share price down 2.9%. Let's have a look at the results. These results are pretty good. So this company has a market cap of 35 million. So keep that in the back of your mind, 35 million. Xtek, this company's profitable. Revenue up 54% to 89 million. Profit up 7%. Not a big jump in profit, but 6 million. So profit of 6 million, market cap of this company is 35 million. So we're talking about a P ratio of, 6? P ratio of 6. So obviously, the market doesn't think these sort of results can continue into the next few years. Even though management, I'm pretty sure, did say they expect growth in financial year 24. The market is skeptical. If the market is wrong, this is a cheap company. And that's the only reason I'm a little bit hesitant to sell my shares in this company, even though the share price is in a downtrend, just because it just looks really, really cheap. The main reason I took a position in this company was way back here when some positive news was coming out. I think I added to my position. I was a long-term shareholder, added to my position here, beautiful uptrend in share price. And then something happened in February this year. I don't know what. It wasn't that negative. What are they released? Maybe that's the problem. They didn't release anything. These documents are still opening up, MoneyMe and genetic signatures, but that's all I want to talk about when it comes to Xtek. Now to a company called RPM Automotive Group. So on the 30th of August, this company's share price rose 23.8%, and today share price decreased 15.4%. Not a lot of volume either. I'm not even sure why I'm including this company, because based off the volume, the only reason the share price is quite volatile is because of liquidity issues. That's more than likely. They actually released their results today, not yesterday. In fact, they released it at 2:08 p.m. So why did the share price go up so much yesterday? Again, that's not a factor of any good news flow from the company. It's just a factor of the stock price of, or the shares in this company being illiquidly traded. So I'm not even going to have, actually I will. I was going to say, I was not even going to have a look at the results. So revenue, $117 million of revenue. What's the market cap of this company? 24 million. Must have really low margins. Let's have a look at the margins. So revenue, 117 million. Profit, gross profit, 37 million. Reported EBITDA, 8.8 million, profit after tax 1.8 million, profit down 38%, profit after tax 1.2 million. So really pathetic margins for this company, and down 50%, profit down 50%, even though revenue's up. So margins have been even more squeezed. It says here increased gross margin, but margins elsewhere have been totally squeezed. Anyway, that's all I'm going to say about RPM Group. Genetic signatures. So let's have a look at genetic signatures first. What was I going to look at? Oh, the results. I totally forgot I was going to look at. This is what I wish all companies release: a media release and a presentation. Some companies just release their annual report or financial results, and then you just have to dig for the results. So here we are. Revenue from operations down was halved. Loss 14.1 million. Well, straight away, don't have to look at anything more. Cash has decreased from 36.9 million to 16.3 million. That's all I'm going to have to look at for genetic signatures. And it does not want to open up MoneyMe. Not sure what's wrong. And the last company I want to look at is NextEd. I mentioned this company in a video a few weeks ago because the share price decreased 29.2%, and I thought maybe that's an overreaction for the market. Then the share price kept on falling. In fact, the share price went from about 80 cents down to 69 cents. And then all of a sudden today, the share price has increased 35% on huge volume. So let's have a look at NextEd. 35%. They released their results on the 28th of August. This has nothing to do with the results. So they've gone into a trading halt, pausing trading at 3:05 p.m. This is more than likely a ASX price query. They want to know from the company a price and volume query because it's pretty big volume. Why are your shares 35% higher when you've released no news? Your results were on the 28th of August, which was 3 days ago. So let's have a look at the trading halt for NextEd. I did say possibly the market was overreacting. So this could be just people listening to me, maybe. I don't know. Delayed listening because I said that a while ago. Yeah. So NextEd making an announcement in response to the price query from ASX and government announcement or something. What does that mean? Price query from... Oh, the trading halt is requested pending the company's response to a price query from ASX and the recent announcement by the Australian government regarding the closure of the pandemic event visa. Okay, it's all clear now. The reason why the share price decreased a lot the other week was because of this visa that was supposed to come to an end, and the government decided to extend the visa. So it looks like they've decided to stop this visa, and that's beneficial for NextEd Group. So sometimes it doesn't pay to overreact, like on the 17th of August, only 2 weeks ago. So it only took 2 weeks. Now, you could say the share price, $1.06, is well lower than the share price was before the share price decreased a lot. So we're talking about a 15% difference in share price. So there's a bit of an arbitrage there, possibly. Still trying to MoneyMe, still trying to open up. Probably should. It's taking ages. I forget what I wanted to show you with MoneyMe. I'm pretty sure this is ComSec because yeah, my system, the fiber to the premises would open this up in a split second. So gross revenue. That's right. I wanted to see what this operating cash profit was. I have a feeling it's operating cash flow. Be able to see again when we look at this company's cash flow statement. Here we go. No. Okay. This is weird. They've got an operating cash flow of 208 million. Obviously, that's not 208 million. And proceeds from borrowings 244 million. So I'm not sure what their operating cash flow or cash profit is. which I've completely forgotten right now. I'm trying to find somewhere where we see that number somewhere, and I can't see it. Maybe it's this. No, it wouldn't be that. Anyway, that's all I should talk about in this video. It's gone for over an hour. If you have any questions about any companies I've mentioned in today's video, just leave any of your thoughts in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. I've got to put a pie in the oven because this video has gone way longer than I expected. And the last thing I should say is, if I've already said it, I can't remember. I am a little bit tired. I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.